One of the biggest reasons traders stay confused is because they keep switching time frames without actually knowing what each time frame is supposed to do. So they look at the 4-hour time frame, and then the 1-hour time frame, then the 15-minute time frame, then the 5-minute time frame, and by the time they are ready to enter the trade, they are completely lost. They look at one time frame and they think that price is actually very bullish right now. And then they switch to another time frame, then they see price is actually very bearish. So in this case, should I enter for a buy or enter for a sell? Now, the problem is usually not the chart. The problem is that they do not yet understand how to read multiple time frames together. They don't understand that multiple time frames doesn't mean the market is doing different thing. It just shows you the different layers of the market itself. Multi-time frame analysis is not just about looking at more charts. It's about knowing what each time frame is telling you and how they all work together. So that's what we're covering in this lesson. So far, we have already covered a lot of very important concepts like market structure, supply and demand, premium and discount, fair value gaps, order blocks, all this good stuff. In this lesson, I want to show you how to combine these ideas across multiple time frames. The higher time frame will give you the bigger story. The lower time frame will allow you to trade with precision. So you need to understand how they all work together. When you do, your analysis will be a lot more clearer. Right, so with that being said, as usual, I'm just going to go through the theory first, right? Just understand the chart diagrams, understand the logic behind multi-time frame analysis and why we use it. Then later, we are going to go into the charts and apply this. Okay, so what is multi-time frame analysis? Multi-time frame analysis is basically the process of reading the market from higher time frames down to the lower time frame in order to understand the bigger picture and find direction and refine execution. Quite simply put, you are using multiple time frames so that you can determine the trend direction, so you can trade with smart money, and still at the same time trading with sniper-like precision on the lower time frame itself. So it's not just about checking random time frames, it's about understanding each time frame and using each time frame for a very specific job. You're supposed to use the higher time frame to do this, the medium time frame to do that, and the lower time frame to do this. Now, going down the time frames is like zooming into price action. That is why I view top-down analysis or multi-time frame analysis or whatever I like to call it as having a microscope. You know, just zooming into what price is doing on the lower time frames itself, right? That's just you looking at like what you can't see with your bare eyes itself. And the reason why we use multi-time frame analysis is because if you don't, what tends to happen is that you're going to get trapped trading against the bigger trend, right? For example, if you just only look at a 5-minute time frame and you neglect the daily time frame, what tends to happen is that you look for a sell because the 5-minute trend direction is bearish, but then next thing you know, price starts going up significantly because the higher time frame trend, the daily time frame trend is actually bullish. And the higher time frame trend will always have much more power and control over the lower time frame trend. So as a result, you get trapped in the wrong direction because you neglected this multi-time frame analysis. So when you have multi-time frame analysis, what tends to happen is that you have a lot more clarity over the trend direction, which also means that you will get better timing of your entries. And it also means that you will stop forcing trades in the wrong context. So like I said earlier, the higher the time frame, the more powerful the information is. The monthly time frame will be much stronger than the weekly time frame. The price action that you see on the weekly time frame is going to be much more stronger and much more significant than the ones that you see on the daily time frame, daily over the 4-hour, and so on and so forth. Right? You basically get my point. The higher the time frame, the stronger the price action is. So if I see like a big bullish candlestick on the daily time frame, this tells me that over the next few days, there's a very high chance for price to remain bullish compared to if I see the same bullish candlestick on a 1-minute time frame. It might just not have as much significance as the one that has appeared on the daily time frame, right? Because yes, higher time frame, much more significance, much more powerful. So when it comes to multi-time frame structure, you must understand this logic right here. If you understand this logic, everything becomes much more simpler. And that is the fact that a higher time frame trend is a higher time frame run is a lower time frame trend. So what I basically mean by that is that, once again, just applying the concept of market structure, a price is creating higher highs, higher lows. This is an uptrend, right? So this entire move right here is a trend. But within this trend itself, there are certain legs, right? So we will call each one of these legs a run, right? So price goes up, pulls back, goes up, pulls back, creating higher highs and higher lows, right? So each one of these legs where price is pulling back or price is continuing is counted as a run. So looking at this, it basically said a higher time frame trend is a higher time frame run is a lower time frame trend. So what it basically means is that within this entire leg itself, it might look like a straight line on the higher time frame, but if you go down to the lower time frame itself, you will see price creating higher highs and higher lows, right? Because that's what price will be doing on the internal structure, on the lower time frame trend. And that's what formed this entire leg itself. So just to give you an example on what that essentially means, right? So this right here is a run, another run, and then another run, and then another run, right? So every time price move up is a run. And then if you look at it using a microscope, right, which means you jump down to the lower time frame and look at this entire leg right here, what you will see is these gray lines that we have behind the thick black lines right here. This is like the lower time frame structure, where price is creating higher highs, higher lows, higher highs, higher lows on the lower time frame itself. And then later on, you can see the lower time frame starts shifting bearish first, then the higher time frame starts shifting bearish later on. Okay, so this is what we mean when I say that price is fractal. The market is fractal. So whatever happens on the higher time frame, it must first happen on the lower time frame itself. So another example right here, right? This one is a little bit more complex, but just to show you this entire logic. So the daily time frame could just be price goes up, pulls back, and then goes up, right? It just could be like this blue line that you can see on the screen right here. But remember, within this line itself, if you go down to one time frame lower, right? So let's say you jump from the daily time frame to the 4-hour time frame, what you will see is the price creating higher highs and higher lows to form this daily time frame trend, this daily time frame run right here, right? So this one daily time frame run is actually a 4-hour time frame trend. Same thing right here, right? And same thing right here. And then within the 4-hour time frame run, right, which is this push to the upside, push back, and then push to the upside and push back. If you look at each one of these legs, it also further comprises of trends that is going on the lower time frame, perhaps on the 15-minute time frame itself, right? So if you look at this right here on the 4-hour time frame, it might look like a straight line just like this. But if you jump down to the 15-minute time frame, this is where you'll start seeing price creating higher highs, higher lows, higher highs, and higher lows, and all of that comes together and form this entire 4-hour leg here. Same thing within this 15-minute trend itself, there's also your 1-minute trend itself, your lower time frame trend, right? That is going on in a microscopic level. Yeah. So you basically get my point right here. So when you perform multi-time frame analysis, what you're doing is that you're analyzing the charts from the higher time frame down to the lower time frame. The higher time frame tells you like where's the institutional flow of money. The lower time frame tells you the precise place and time you want to enter the trades, right? Which is something that we're going to talk about later on. So your lower time frame price action forms your higher time frame price action. Okay, so literally like what we've mentioned, a higher time frame trend, a higher time frame run is a lower time frame trend. So all of these lower time frame trends, higher, higher, higher lows, comes together to form your higher time frame run, which is just one straight line to the upside. And your higher time frame price action create your higher time frame runs, right? Like this move to the upside or to the downside, which in turn creates your lower time frame trends. And then that make up your lower time frame price action. So the lower time frame has to shift first before the higher time frame actually shift. So the same patterns actually repeat themselves over and over again. Whatever happens on the higher time frame must first happen on the lower time frame. So whatever principles that you guys have been learning when it comes to market structure, when it comes to supply and demand, when it comes to premium and discount, you can apply it across every single time frame. But just understand that if you apply it on the higher time frame, It's for a different reason compared to if you're applying it on the lower time frame itself. So it might take a little bit longer for the trade or the idea to actually play out on the higher time frame, because you can apply the same strategy, the same concept, because of the time frame that you're applying it in. There's got to be like a different time horizon in which the idea can essentially play out. So as traders, as market mechanics traders, we typically use 3 time frames: a higher time frame, a medium time frame, or a lower time frame itself. And like I said, each one of these time frames serve a specific purpose. You need all 3 time frames. You cannot just have one time frame. You need all 3 in order to make sense of the market, in order for you to define a trend direction, so that you can actually develop a trade ideal, so that you can actually get in at the best price, at the right place, at the right time, at the right trade ideal, right? So remember, I think in one of the first few lessons, I talked about how success in trading requires you to form the right trade ideal at the right place, at the right time. So that's what this multi-time frame analysis is about. It allows us to achieve that. So I'm going to show you some examples on like what time frames that you can potentially use as your higher time frame, medium time frame, and lower time frame later on. But for now, I just want you to really just understand the purpose of each one of these time frame right here. The higher time frame is used to build the narrative. It's used to identify the trend direction. Okay, so this is the time frame that tells you who's in control of price, supply or demand, buyers or sellers. Right, this is where you can determine the prevailing trend direction, so you can trade with it. So when you are on the higher time frame, you want to be asking yourself these few questions. Is the market bullish, bearish, or ranging? Where is price relative to key supply and demand? Is price in premium or discount? What liquidity is nearby? Once again, something that we're going to talk about in the next few lessons. Are we approaching an order block, fair value gap, or a major zone? Because if we are, then we are expecting a reaction from that area. And then for your medium time frame, this is where you're using it to determine your immediate bias, which is what price is doing right now. And you can also use it to identify your point of interest, aka your supply and demand zones, your order blocks, your flip zones, your liquidity zones. So after the higher time frame gives you the trend direction, the medium time frame helps you refine the dealing range, the range in which you want to focus on, the exact zone in which you want to enter the trade from, the internal structure, and whether price is approaching your area properly. Right? So medium time frame is like that sweet spot between the higher time frame and the lower time frame. It's the middleman essentially. Okay, so it allows you to like just gain more clarity over what price is doing, gather more evidence, right, before you actually look for your entry. And also determine like exactly where you are looking for your entry, which is usually your point of interest, right? Your supply and demand zones or your order blocks. And then once price mitigates or touches or enters the medium time frame point of interest, your supply and demand zones, your order block, once again, this is where you can jump down to the lower time frame. And the lower time frame is for you to wait for price to enter into your area, and then when it does, look for your entry confirmation, look for your entry model, and then once that presents itself, you enter into the trade with confidence. Without any fear, without any hesitation, you just enter with confidence once you have seen your confirmation on this time frame itself. And this is where you can refine your entry, you can have your tight stop loss, and place your take profit right here. So as you guys can see, each one of these time frame has a specific purpose, and if you combine all of them together, you will be able to see the market for what it is. You will have the best chance to actually read price for what it actually is. So yeah, make sure you utilize these 3 time frames itself. So with that being said, let's go on to the charts right now and try to apply all of these theories that we have just learned. So I'm going to give you some example, right? Maybe the first example that I want to showcase to you guys is on EURUSD, right? So let's look at EURUSD chart together right here. Okay, so here on the top left-hand corner, you have seen I've laid out a set of time frames, right, for you guys to actually copy. Depending on your trading style, you're going to be using a different set of time frames. So it's very important that you actually take the time out to determine which trading style suits you the best, right? And you're able to find out based on your commitments, your lifestyle, your risk tolerance, and your goals. Okay, so once you have decided which trading style, right, you want to specialize in, whether the swing trader, which is people who are holding the trade for more than 24 hours, up to a few days or even a few weeks, or a day trader, which is just opening and closing a trade within 24 hours, not trying to hold the trade overnight, or scalpers, which is the short-term traders who are getting in and out within a few minutes, anywhere under less than an hour. Once you have decided which trading style you want to specialize in, find that trading style and then stick to the set of time frames that you're assigned to. Okay, so if you're a scalper, this is the time frame that you're going to be using. If you're a swing trader, this is going to be the time frame that you're using, and this will be a higher time frame, this will be a medium time frame, and this will be your lower time frame. Okay, so yeah, just now we have already like talked about the purpose on like each one of these time frames. I'm not going to dive deeper into this right here. I'm just going to show you how to actually do this multi-time frame analysis or top-down analysis right here. So in this case, I'm just going to use the day trader set of time frames as an example for you guys, right? So I'm going to be a day trader, which means my higher time frame is the 4-hour, my medium time frame is the 15-minute, and my lower time frame could be the 5-minute time frame itself. Okay, so let's look at this chart over here. So first things first, always start from your higher time frame. All right, that's the first thing. You don't want to take a bottom to up approach. You want to take a top to bottom approach. What I basically mean by that is that a lot of times beginners tend to start with the lower time frame, right? So beginners, they immediately like to jump to the 5-minute time frame, see what price is doing over here. If price is going down, they just enter for a sell here. Or they go down to the 1-minute time frame, see price is going up, they just enter for a buy somewhere around here. That's not how you should be trading. Because if you start from the lower time frame, you're essentially building a bias from noise. All of this price action has very little significance over like where price is potentially heading towards next, right? So what you want to do is to start from the higher time frame. Okay, so once again, let me just put it into simple English. If you trade and you start on the lower time frame, the 5-minute, the 1-minute, or even the 15-minute time frame, what you're essentially doing is that you're putting blinders on yourself. You know those horses with like the blinders on themselves, which prevents them from seeing their surroundings? That's what you're essentially doing. You will only be able to see what price is doing on the 5-minute, and you will not be able to see what price is doing on the higher time frame, which is actually the price action that determine where price is heading towards next. So even though price is going down on the 5-minute time frame, you enter for a sell. Next thing you know, price start reversing heavily against you because the 1-hour time frame, the 4-hour time frame is heavily bullish right now. All right, so always starts top down, not bottom up. Start with the higher time frame, right? The first set of time frame, which is the 4-hour, and this is where you want to build your narrative and determine your trend direction. So clear as day, price has been going up, right? Price is creating higher highs, high lows, higher highs, high lows. This is where I want to take my line to and just map out all the structural breaks that has been going on for the past few days, right? So there's one right here. Okay, so and then there's maybe another one right here. And then there's another one right here. Okay, so just by doing this alone, I can see that, okay, all of these are actually my bullish break of structure, where price is just going up, creating higher highs, higher lows, higher highs, and higher lows. And just by doing this alone, I know that the market is in an uptrend, which means that buyers are in control of price. Okay, buyers are in control of price. So as much as possible, if I want to trade with the trend direction, the higher time frame trend direction, this is where I will potentially want to look for longs at demand zones that is within your discount range, just like what we have covered for the past few lessons. So after you determine your swing structure, this is where you can define your swing low and a swing high, right? This will be the swing low, but you can see the swing low has been taken out recently since this is the lowest point that led to the most recent break of structure, therefore creating a market shift. All right, so what does this tell us? This tells us that right now, price have potentially shifted bearish so that it can pull back to this last low right here before continuing bullish. At least that's our expectation on what price could potentially do. Okay, for me to know for a fact that price is going to shift bearish, I want to see price take out this low here. Okay, so over here, if price just take out this last last low right here, last internal low. This is just price shifting bearish in the short term to facilitate the pullback. So right now, even though higher time frame trend is bullish right here, what is price doing right now? Okay, so that's another thing. That's what we use the medium time frame for. What is price doing right now? We need to determine our immediate bias so that we can trade with the internal order flow, so that we can trade with the immediate price action, which is what price is doing right now. So over here, another thing that you could have done on the higher time frame is to, like, once again, just map out the previous low right here, swing low, and then this your swing high. If you want to be like super duper mechanical, you might even want to map this out as your internal break of structural instead of your bullish break of structural, right? So if that's the case, then this is the swing low and this is the swing high. And right now, like I said, price has shifted bearish to facilitate the pullback itself. And then this is where you might even go one step further to map out your premium and discount. And then you will realize that price is still quite higher up within the premium pricing. So if I want to look for longs, ideally I want to see price comes down into this discount range right here. And ideally I want to see it mitigate some form of demand zone, right? So once again, there's a demand zone right here, and then there's potentially another demand zone over here. Okay, so maybe if I'm looking for longs, I want to see price comes down, mitigate this zone or this zone, and then I can look for longs to trade in this particular direction itself. So that's what you essentially do on the higher time frame. You just build the narrative, you just try to figure out what is the market trying to tell you right now, and what is, like, who is in control of price, right? Whether the buyers or the sellers. Once all of this is done, then this is where you can jump down to the medium time frame. So for me personally, when I'm trading, I like to use the 1 hour time frame and the medium 15-minute time frame as my medium time frame, right? So I like to use both. Even though here only recommend you to use one, I personally like to use both, right? Because to jump from 4 hour to 15 minute is like a very big gap. So I prefer to use 1 hour as like the middleman between like 4 hour and 15 minute. But once again, completely up to you. I just wanted to show you 3 time frames for simplicity's sake, right? Because I know a lot of you guys are not ready to have 4 different time frames. You guys are not even ready to have 3 time frames. Having 4 is like, it's just gonna drive you mad, innit? So yeah, I would say like stick to whatever works best for you, but this is based on how I personally trade. I like to have the 1 hour as like a sweet spot, like the best media time frame between the 4 hour and the lower time frame, which is the 5-minute time frame. So on the 1 hour time frame itself, you can see price started shifting bearish. Okay, cool. Let's go down to the 15-minute time frame, which is our officially medium time frame, and this is where you can see 15-minute time frame has already shifted bearish. How do we know price shifted bearish? Price came all the way down here, taking out the last higher low, giving us a market shift. Okay, so just by that alone, we know that, okay, right now, the internal structure is actually bearish. So if we enter for a buy somewhere around here, it's kind of trading against the lower time frame trend. It's also trading against the internal order flow, right? So maybe it's not the best time to look for shorts. I mean, maybe it's not the best time to look for longs. Maybe it's a good time to look for shorts. At least short it all the way till price comes down to the discount range or comes down to this demand zone or this demand zone right here. So this is how we can go about if you want to trade counter trend, right? The reason why I say it's counter trend is because right now, lower time frame is bearish, but the higher time frame is bullish. So if you were to look for short, you are actually trading with the internal structure, but you're trading against the higher time frame swing structure itself. All right, so let's continue mapping this up, right? So on the 15-minute time frame, on my medium time frame, what is my objective? My objective is to determine the immediate bias and map out any point of interest, right? So in this case, the immediate bias is that price is actually bearish. And then this is where maybe I want to draw my 15-minute structure as high, structure as well, 15-minute swing high, and then 15-minute swing low right here. And then this is where I can potentially wait for price to pull back to some form of supply zone, then look for shorts, right? So this is where I can come here, try to identify every supply zone over here. There's one over here on the extreme, right there. And then there's maybe another one right here. Okay, another one right here. And then this is where, once again, you can use the premium and discount as well, right? Drag it from the swing high to the swing low, you will see that. Over here, price is still within the discount zone. So if you want to look for short, it might be a little bit too early, right? You might be much better off waiting for price comes down up to this supply that is within the premium pricing, or even this one right here. Get your entry confirmation, get your entry trigger, then look to short it all the way down here. Now you can start to see the different pieces of the puzzle start coming together. Now you can start to see, okay, I need to use supply zone plus premium discount plus structural plus multi-time frame analysis for me to actually develop a trade idea that is congruent with the market. Now I can start to use all of these market mechanics concepts to try to decrypt what the market is trying to tell me. Yeah, so I'll say like, in this case, once again, I'm not going to dive too deep into entries and exits because this is a lesson where we talk about multi-time frame analysis, right? But I wanted to observe what price does, okay? So this is where price is at right now. Let's observe. Okay, price is actually bullish right now. Okay, are we surprised that price is bullish? No. Why? Because just like what we have mentioned, the market cannot go down forever. It cannot go up forever. After a huge move to the downside, it needs to seek balance again. It needs to get more fuel. And where is it most likely going to get fuel from? It's got to get fuel at some supply zone. But is it any supply zone? No. It's usually going to be at a supply zone that is located within the premium range, above the 50% equilibrium level, within the swing range itself, right? Because this is where the fair value is stated at. This is where there's more sell orders for price to continue going down even further. Okay, so just as what we predicted, right, prices came all the way up here. Now, if you are a scalper, this is where you can potentially even look to trade this move right here. Or even if you're an intraday trader, right, you can try to capture this move to this area here. And I'm going to show you how to do that right after this example. I'm going to show you a trade that I've taken, which is me literally capturing this move right here. Okay, and I'm going to walk you through like my thought process behind this entire trade and how I apply multi-time frame analysis on it. But before we do, let's not get too ahead of ourselves. Let's just continue to observe what price does, right? Because this is where I wanted to really see how powerful this multi-time frame analysis thing is. Okay, so over here, what happened? What happened was that price has literally came up here, mitigate the supply zone that is within the premium pricing. So you can see, price did not start coming down when price came up here. No, there was not enough fuel. So it needs to continue going up till it comes to the gas station, grab more fuel, then go down. Like I said, nothing ever happens. Nothing that happens in the market is mere coincidence, right? Every single move is planned out. Every single move has a purpose. So in this case, the purpose was that price just needs to go up there, grab more liquidity before the real move actually happens. Now, I want you to observe what price did. When price mitigate this supply zone to grab more liquidity, look at the internal structure that we have right here that is being formed. Price goes up, pulls back, goes up, pulls back, goes up, pulls back. So we know that price has shifted bullish because price is creating higher highs and higher lows on a 15-minute time frame. But does this mean that price has shifted bullish because the trend is reversing? No. If price take out this high here, then yeah, maybe price is reversing. But if it doesn't take out that high, this just tells us that price have shifted bullish in the short term to facilitate the pullback. Okay, facilitate the pullback to this supply zone. And when it does that, this is where price consolidated a little bit. Later on, price came down, take out the last internal low, giving us a market shift, which tells us that the internal structure has shifted from bullish to bearish. So if you were to look for shorts, the best place to look for shorts is at this supply zone that is within the premium pricing. Once you got the entry confirmation that tells you that the structure is shifting bearish, by all means, go and look for short, and this is where you can trade it all the way down here or even till here if there is enough fuel in the market. And if you look at this, does this look familiar to you? Right? Like, does this look familiar to you? Okay, so just to make it even more obvious, this is the last breakout structure right here. And then later on, price came down, take out the last internal high low, giving us a market shift. Right? I want you to take a snapshot of this price action here, this portion here, right? Remember this. Now, this is what price is doing on a 50-minute time frame. Let's go back to the 4-hour time frame. Do you see it now? It's literally the exact same price action, just on a different scale, just on a different price, just on a different time frame, That's what I mean when I say the market is fractal, right? You will see the same patterns across different time frames. Just now on the 15-minute time frame, we saw price goes up, pulls back, goes up, pulls back, and then goes up, and then comes down, breaks structure, causing the internal structure to shift bearish. Guess what? On the 4-hour time frame, we have seen the exact same thing. After price has shifted bearish, after the market shift is formed, price is pulling back, and then now it's going to start going down. Let's go back to the 50-minute. After the market shift is formed, price has came down, and now it's starting to pull back, and now it's going to go down. Same exact price action. That's how you apply multi-time frame analysis. Okay, so now let's just continue to observe what price does. Okay, so price continue going down, continue consolidating around here, right, creating a lower high, and then it comes down. Okay, cool. Now let's talk about the lower time frame, since we haven't talked about the lower time frame yet. So you only enter into the lower time frame, which in this case is the 5-minute time frame for a day trader. You only go down to the lower time frame once price have touched your medium time frame point of interest. This prevents you from trading when price is in the middle of nowhere. So in this case itself, let's say price was over here. Okay, price was over here. And we have mapped out our 15-minute supply zone, this one right here and this one right here. So these are the two locations in which we want to enter the trade from. This means that when price is hovering around here in the middle of nowhere, we do not go down to the lower time frame. I'm not going to jump down to the 5-minute. I'm not going to jump down to the 1-minute time frame. I'm doing nothing until price touches either one of this zone here. So I'm still over here waiting very patiently, or maybe I would like to set an alert right here at the edge of the zone, and then I just wait. Boom. The minute price touches that zone, you jump down to the lower time frame to look for your entries. So this is where you jump down to the 5-minute time frame, your lower time frame, to look for your entry confirmation. You look for entry triggers, look for entry confluences. And then once you got the entry confluences in this time frame itself, then you can look for shorts. Right? So we're going to delve deeper into entry confluences, entry models in the next few lessons, right? But for now, just to give you like a quick little example, right? So in this case, look at the internal structure. Price came up here, came down, and then took out this high here as well, right? Took out this high here. But this turns out to be a liquidity sweep. After the liquidity sweep, price came down and took out this last low over here, giving us a market shift, right? So this is going to be one of the entry models that you're going to be learning very, very soon. But once you see this pattern itself, and it happened right after price mitigate the zone, this is where you can look for shorts, right? This is where you can look for short, and then this is where you can look to short it all the way down, right? So once again, gonna delve deeper into entries and exit the next few lessons. For now, just get really good at using this different time frame. Okay, so in this case itself, I'm not sure why TradingView is taking so long to load these days. It's really testing my patience. Okay, let's just wait a little bit, man. Yeah, so anyways, in this case itself, what happened was that the lower time frame, the 5-minute time frame, started shifting bearish first before the higher time frame, the 50-minute, actually shifted bearish. Okay, you guys saw this was the lower time frame structure, right? The 5-minute structure started turning bearish first, then the 50-minute time frame started turning bearish. So like I said, whatever happens on the higher time frame, it must first happen on the lower time frame. So in this case, let's continue to observe, right, what price does. Okay, so we got a market shift over here. Price started shifting bearish, Okay, cool. And then we got a break of structure to the downside right here. And then now price is creating lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, and then lower highs again. And once again, this is the beauty of market structure, right? So this is the supply zone that led to this break of structure. And look at where price pulled back to. Pullback mitigated this supply zone. Or if you want to make it even more refined, guess what? What is this? This is your good old fair value gap, right? Fair value gap, imbalance, right? Another imbalance right here, which means that there's an order block over here. Okay, so this is actually a good old juicy order block. So once again, using the concept that I just walked you through, this is a 15-minute order block, right? So on the medium time frame, we have determine our embedded bias, which is bearish right now, and we have mapped out our point of interest, which is the 15-minute order block that we have right here. So in this case, right here, let's say price is somewhere around here. I'm not doing anything. I'm not jumping down to the lower time frame. I'm not gonna be getting itchy fingers to try to enter for a sell right here. No, I want to wait for price to come to me. I never ever chase price. I wait for price to come to me. Okay, so in this case, I'm waiting. Okay, price comes up to this fair value gap. Now I'm interested, right? If I can see a reaction, if I can see the confirmation that price is going bearish right here, then I can look for shorts, right? Okay, so if you're a scalper, you could potentially have caught this move right here, this tiny move right here, after the fair value gap itself. But let's say you miss this move here. Then next, cool. You do nothing, right? You are very patient. You tell yourself that you don't chase trade. Okay, the move has already happened without me. Now I'm chill. I'm waiting for price to come to my next point of interest, which is the order block. Okay, so the minute price step into the order block just like this, boom, straight away, go and look for entry confirmation on the 5-minute time frame itself, right? The lower time frame. And if you see your entry confirmation, by all means, take a good old short position right here and then watch price collapse. Right, you can see the entry is the last thing you do. The money is not made in clicking the buy and sell button. The money is made in the preparation that comes before that. The money is made in the entire top-down analysis, the multi-time frame analysis. The trade idea, the entry is only just one little piece of the entire puzzle itself. So when you see me capturing, high R trades, when you see me making 6 figures on a given trade, understand that it was not because I identified a bearish candlestick at this zone, then I enter for a sell. No, it's because of what came before that. How I developed my trade bias using the multi-time frame analysis. So the entire process contributed to me catching this trade itself. Okay, so that's multi-time frame analysis, right? I've pretty much walked you guys through how to use these 3 set of time frames as a day trader. Now maybe let's try to look at another example on a live trade I've taken, but this time around, let's look at it from the eyes of a scalper. So if I'm a scalper today, I'm gonna be using the 1 hour time frame as the higher time frame, the 5-minute as my medium time frame, and the 1 minute as my lower time frame itself. And that's what we are doing in this case itself. Okay, so right here, I'm on the 1 hour time frame here. So maybe let me just see, let's just go back to where price was, like somewhere around here. Let's go back to my entry and I can walk you through everything. So let's say right now, 1 hour time frame, I'm a scalper today. I'm getting in and out fast, which means I don't really need to care about what price is doing on the daily time frame or the weekly time frame, because I'm literally developing my trade idea within the next few minutes and just getting out within the next few hours, right? So the daily time frame, the weekly time frame doesn't really concern me as much as it concerns a swing trader or a day trader. It still affects you, right? Don't get me wrong, right? Like I said, the higher time frame trade ideal is always going to be much more stronger than what price is doing on the lower time frame. So if you want, you can still take a look at it, right? But just don't put too much significance over the daily time frame itself, because you, as a scalper, your higher time frame will be the 1 hour time frame itself. So 1 hour time frame, this is my higher time frame, and I'm developing my trade bias by identifying the trend direction and mapping out structure, right? So you can see price is creating a bullish break of structure right here. But the thing is that the market has shifted bearish when price took out this low over here. So this is where I had my good old market shift over here. And then now this is where I can find that this is my 1 hour swing high and this is my 1 hour swing low. This is the range that we are trading within right now. And after this huge imbalance to the downside, I'm expecting the market to come up to a balance again. I'm expecting price to start shifting bullish in the short term, right, to fill up all of this imbalance on the left hand side right here. So this is where I can take my premium and discount you, drag it from the swing high to the swing low just like this. And this is where I'm plotting out the supply zones, the order block in which I can expect price to gravitate towards next. That's me plotting out the gas station that price is moving towards next to grab more fuel before going down even further. So in this case, obviously, find the imbalance, right? Find a strong displacement, huge displacement right here, And then this right here is the origin point. So this becomes the order block. Okay. So this one is very obvious, right? Because we got a huge, strong bearish candlestick right here. And the origin point is this candlestick right here, this origin candle here. So that's the order block. And then you can also map out the other supply zone if you want up here, right? So this tells me that the first place that price is moving towards next is going to be this order block. So in this case, that was my analysis on the 1 hour time frame. I've identified the trend direction, which is bearish, but on the lower time frame itself, it could potentially shift bullish in the short term to facilitate the pullback, right? So even though the higher time frame is telling me that price is bearish, if I jump down to the lower time frame and the medium time frame to develop my immediate bias, I will actually be looking for longs, right? Because I want to trade this pullback all the way up to this supply zone right here, right? Or even this order block here. So this is where I jump down to the 50-minute time frame. And same thing, right? You can map out your 50-minute high and 50-minute low right here. This is the 50-minute swing range in which we are focusing on. And you can also map out any other supply zones or order blocks that you have missed on the higher time frame itself, right? So in this case, this was the 1 hour order block that we have mapped out. And then I also map out this other 15-minute supply zone right here. Okay, the reason why I mapped that out is because price came down, pull back, and then goes up. And it is also an order block. It's not just a supply zone. Because if you look at the next candlestick, there was imbalance, right? So this is the order block. So you can see, if you didn't do this on a medium time frame, you have missed this point of interest itself. You have missed this step. Okay, anyways, in this case, we got the 1 hour order block that is situated quite high up there, and then there's this 15-minute order block here. All right, so this is where price is moving towards next, because the market is moving from imbalance to balance to imbalance again. All right, so that's the gas station, yeah? Okay, so that is my target. But where do I want to enter the trade from? Well, since I'm trading the pullback, I do want to look for longs. But where do I want to look for longs? I don't want to look for longs when price is at a high. I want to look for longs where price have just created a new high low, and right now price is going to go up just like this. So in this case, I map out my 15-minute structure, and I found out that price is creating higher highs, higher lows, just like this. And you can see, every time price came up there, create a high, it swept some liquidity, and then go up there, break structure. Same thing right here. Okay, so in this case, this is the demand zone that led to the previous break of structure. I saw price mitigated that zone, and this is where price started shifting bullish. And I know for a fact that price is just going to continue bullish until it reaches this area here. All right, so this is where I map out my lower time frame demand zone, and the minute price tap into this area here, then this is where I jump down to my 5-minute time frame and I look for my entry. Okay, jump down to my lower time frame to look for my entry itself. So I personally like to use the 50-minute as the medium time frame, and then the 5-minute and the 1 minute as the lower time frame. So I will actually use both the 5-minute and the 1 minute as the lower time frame. 5 minutes to just, get my entry. 1 minute sometimes to just refine my entry even further, right? Just to get like even more of a sniper entry. So in this case, what do we have? We got price mitigating this zone right here, creating a new higher low. And then right now, price has given us clear as day bullish confirmation that tells us that price is going to head up this way here. So this is where look for longs here. Okay, after you look for longs, price started coming up here. And then this is where I believe I placed my stop loss like below this low initially. I forgot where exactly I placed my stop loss, but I think it was like somewhere below this low. And then eventually I moved it up to below this low because I actually scaled in for this second position. Once again, you guys can see my entire like top-down approach from the moment I enter the trade to the moment I get out of this trade. On my second channel, Brad Trades, I literally documented every single pip move on there, right? You can see me enter this trade live on there itself. But yeah, I'm just giving you like a quick little trade recap. So what happens is that after we got a bullish confirmation, enter for the long for the first position right here, and then later on price pull back to this area here, giving me more confirmation. So this is where I decided to scale in for my second position. And then later on, like I said, I'm pretty much expecting price to move up to this next 15-minute order block. So that's why I targeted the area. And then my stop loss was below this new low right here that has been formed here. Yeah, I can see when price pull back, it was this low here. So my stop loss was situated at below this low here of my second position, right? The internal low that I've entered at. And then later on, price just went up very, very nice. Came into drawdown a little bit, not gonna lie, right? But eventually price went up there slowly but surely and just hit TP, right? But look at what price is doing. Price is just creating those higher highs and higher lows. So this is where, when price was like reversing around here, I wasn't scared whatsoever. And the reason why I wasn't scared is because I trust structure, right? So in this case, this is the last high low. So if that low doesn't get taken out, then the bullish market structure is still intact and my trade idea is still correct. It is still valid. So I will not get phased even though I'm down like 50K at the moment. I'll just continue holding on to the trade idea because I understand market mechanics. Later on, price went up there, smashed my TP, and I made a shit ton of money on that day itself. And this was a trade that I was very proud of because of the fact that I literally caught out the fact that I was going to get a sniper-like trade, and I did just that. Right? Like if you guys go and watch that live trading recording, you will see that when I entered into this position here, I told you guys that I was going to get a sniper entry. And then right after I entered for the trade, price moved up immediately and then eventually went up there with not much drawdown itself, right? So I told you guys I was going to do something and I ended up doing it live. So yeah, that's it, right? So basically, just to sum up everything that we have covered in here, understand that time frames, they don't always conflict with each other. They are just showing different layers of the same market. Because whatever happens on the higher time frame must first happen on the lower time frame. And you tend to see the same patterns across the different time frames. So in this case, daily time frame can be bullish, right? Daily time frame can be bullish. In fact, it was bullish as hell. But right now, the 50-minute time frame could be bearish. And then the 1-minute time frame can be bullish. Each one of these time frame has a specific purpose as well. They are all serving a different role. Okay, they are all serving the higher time frame, which is king, right? The higher time frame is still king. So they are all just like different little ants in a colony, just, you know, playing their part so that they can serve the entire kingdom or the colony. So multi-time frame analysis is really just about using each time frame for a specific purpose. Once again, using the higher time frame to do this, using the medium time frame to do this, using the lower time frame to do this. Higher time frame give you the big picture. Medium time frame tells you where to enter, right? Develop your immediate trade idea, your immediate bias, and the point of interest. Lower time frames tells you when to enter. Okay, so I would say the higher time frame tell you who is in control of price. Medium time frame tells you where to enter the trade. Lower time frame tells you when to enter for the trade itself. And when you learn to read them together, you stop getting lost in the noise and complexity of the market, and you start trading with much more clarity. So yeah, I know this lesson was a little bit long, right? But because this is such a big, chunky topic that I have to spend more time covering, and I really hope that I've made things a lot more clearer for you guys. Don't worry if you're still confused. As time passes, you will just get better at doing this. I would say, when in doubt, just zoom out, right? So whenever you find yourself not knowing what's the trend direction on the lower time frame, always zoom back out to your higher time frame. Go back to the daily time frame. Go back to the 4 hour if you're day trading. Go back to the 1 hour if you're scalping. And then do your analysis from top down. And when you do, you have a much more better understanding of what the market is actually doing. All right, so with that said, I hope you guys have enjoyed this little episode for multi-time frame analysis. In the next few episodes, we're going to talk more about market mechanics concepts, and this is where you should start to build like a little foundation when it comes to market mechanics. Over the next few lessons, we'll just strengthen that foundation and just make it even more robust, right? So you can have a much better idea on how the market fundamentally moves. So with that being said, I hope to see you guys on the next episode. And as always, remember, you're just one trade away.